Hello and welcome to your Mortgage Insider update for this week. We are closing down February and welcoming March. So as we do, we get some interesting reports that come out each week. This week in particular, house price appreciation numbers came out. Now this is a little bit of a lag. This is both with the HFHA and the Case-Shiller reports. Case-Shiller will give us a big picture, the whole country overall coming in at 5.8% year-over-year appreciation. Now that's definitely not 10+% appreciation, but for December 2022, replacing December 2021, that's still appreciation. So it goes to show how being a homeowner did pay this last year. HFHA reports a little bit more appreciation at 6.6%. Now they're only looking at homes with a conforming loan on the home. So it takes out any cash purchases or cash free and clear properties and looks at homes with a mortgage, typically the lower end of the spectrum that the federal government will purchase those loans. They increase it each year, but overall not as big of as a sample, but still showing actually higher appreciation on the lower priced end of the spectrum. So with that, let's talk a little bit more about what's happening in interest rates. We are seeing almost a year high for 2023 in rates, and a lot of this in reaction to last week's PCE, personal consumption expenditure, but a slew of different reports. The CPI report came out this last month, a little hotter than expected. Okay, so today we're going through the overall market. We've got both mortgage-backed security prices are down today. This is, we're going to dive into that a little bit further, but S&P 500's up a little bit, and the 10-year Treasury, this is really going to be the big story. So it is as high as it's been for most of 2023. Let's just take a little look backwards in time here. So the 10-year Treasury, in its history here over the last 12 months has definitely been higher. Briefly back in October, we hit that high point where, effectively mortgage rates were nearing 7%. Freddie Mac keeps a weekly tracking of that. So back in the fall, they had reported interest rates approaching 7%. We saw a huge fallback into December and a little bit of a run up at the end of the year, but since falling back, and we're definitely at a point where you can see we are right above. If we go a little bit shorter time period here, just the last couple months, we can see the last point we had was December 28th. We dropped and we're back up. So what we're seeing is a little bit of a lag in where mortgage rates land to where the consumer thinks that they land. Last time anybody heard, rates were down here. And then the last week or so, I've started to hear more and more people talk about what's going on with interest rates. So let's talk about what's going on with interest rates. So the mortgage rates are held with the universal mortgage-backed security. This would be the conventional loan rates. As the price falls, then your effective interest rate to a consumer. So basically an investor doesn't want the loan. They're going to pay less money for it. And the consumer is going to have to pay a higher rate of return if they want to borrow the money. So we've seen just in this last week, we saw the PCE number, so personal consumption expenditure coming out last Friday, took a huge hit in the market where the price dropped. We hit a floor, and we're going to go a little bit farther back here to see what does this floor really look like in history. So we can see it crossed this area back in September, similar time period to what I spoke about a few minutes ago on the 10-year. The prices settled and then fell significantly back at early October. We had that high point back in October 21st. Since then, we've been in recovery mode, but we've been in a pretty tight range. We've gotten lower here, but we've improved. So when mortgage-backed security prices are at their highest, this is where you want to lock your loan. Well, if you couldn't secure your contract by February 2nd, then every day since February 2nd, we've seen a pullback or a heightening of interest rates. So the investors are less likely to purchase the loans, so the consumers are having to take a higher interest rate. It puts us in the mid sixes to closer to 6.75%, somewhere in that range, depending on credit, down payment. Okay, so why is this happening? The inflation numbers that we're seeing are a replacement of a year-over-year numbers. So we saw in the month of January, consumer inflation came back a little bit. Consumer price index went down very slightly, 0.1 to 0.2%. The personal consumption expenditure actually went up when replacing January of 2022 with the January 2023 data. Now, it didn't go up a ton. It went up 0.6%, but that's going up, right? And that's what the markets don't want to see. Now, as we get through the month of February is ending, we've got by March 10th, we'll get the consumer price index for February. Somewhere after March 10th, we'll get the PCE number, but then really what we're going to start to watch for as we get into the April or the March numbers that end will come out in April and then in May. So between April 10th and May 10th, we could see a reduction in the overall inflation. And what's really going to be interesting is to get into the summer. So you had inflation really kicking into high gear starting in February last year when we talked about earlier, the war in the Ukraine was really just kicking off. Gas prices spiked right up through June. So we saw June was kind of the peak in inflation. Now, it's been stubbornly high, and that's for sure. It's been the ongoing story. That's why we see mortgage rates, they spiked, but then they got worse and worse and worse into October of last year. So where the relief's going to really come in is as we get into the middle of the summertime, July 10th, we'll see the consumer price index that replaces June of 2022. Remember, that was the height as far as oil prices and a lot of the cost, and that'll be replaced with June 2023. We could still have inflation in June of 2023, but it shouldn't be nearly as high. And this is going to be a huge impact to the markets that no one's really talking about right now. But we're going to see this play out over the next couple months. We're going to watch, give you weekly updates, but then monthly we'll start to really put this together and give you some charts to make some sense out of what hopes to be a great second half of 2023. It could be painful for the next couple months in between now and then. So if you're looking to buy a house, though, you can always refinance the house down the road. So take advantage of it today. I know there's limited homes for sale, but if you can secure housing, that's what it's all about. Make sure you get the home that makes you happy. Good luck. Have a great week.